Hello and welcome to Financial Freedom channel. Today I am going to discuss about mutual funds and which mutual funds to select. If you have enough time to research the current market situation and fundamentals of the company, you can directly invest in the stock. If you are doing job and busy with your daily work, better to invest in mutual funds. Investing in individual stocks is like driving your own car. If you know how to drive a car and have the skills and knowledge to make informed decisions, you can navigate the road successfully. However, if you don't have the experience or expertise, you may be at risk of making costly mistakes. Investing in mutual funds is like hiring a professional driver to safely navigate the road on your behalf. The fund manager has the skills and knowledge to make informed investment decisions on your behalf, helping to reduce the risks associated with investing. This can be particularly beneficial for individuals who do not have the time or expertise to manage their own investments. If you're looking to achieve financial freedom through earning money, consider subscribing to this channel. In this channel, we focus solely on topics related to earning money and building wealth. Subscribe to achieve financial freedom. What are mutual funds? Mutual funds are a type of investment vehicle where a group of investors pool their money together to invest in a collection of stocks, bonds, or other securities. The money is managed by professional fund managers who use their expertise to make investment decisions on behalf of the investors. The value of the mutual fund is based on the performance of the underlying investments. If the investments go up in value, the mutual fund shares go up in value as well. And if the investments pay out dividends or interest, that money is distributed to the mutual fund investors. There are many different types of mutual funds, each with its own investment strategy and risk level. Investors should do their research and consult with a financial advisor before making any investment decisions. Benefits of mutual funds: diversification. Mutual funds invest in a variety of securities, which can help to spread out investment risk. This means that even if one investment performs poorly, the others may perform well, helping to balance out the overall performance of the fund. Professional management. Mutual funds are managed by professional fund managers who have the expertise and experience to make informed investment decisions on behalf of the investors. This can help to reduce the risks associated with investing and potentially increase returns. Liquidity. Mutual funds are generally considered to be a liquid investment, which means that investors can buy and sell shares at any time. This can provide flexibility and convenience, allowing investors to easily access their funds when needed. Affordability. Many mutual funds have low minimum investment requirements, making them accessible to a wide range of investors. This can be particularly beneficial for individuals who are just starting to invest or who have limited funds available. Transparency. Mutual funds are required to disclose information about their holdings, performance, and fees, which can help investors to make informed investment decisions. Overall, mutual funds can be a great way to achieve diversification, access professional management, and potentially achieve better returns, while also providing liquidity, affordability, and transparency. Which mutual funds to select? Choose mutual fund which has a low expense ratio. Expense ratio is a fee charged by mutual funds to cover the cost of managing the fund. The expense ratio represents the percentage of a fund's assets that are used to cover operating expenses, such as management fees, administrative expenses, and other costs associated with running the fund. The expense ratio is deducted from the fund's assets before the returns are calculated and distributed to investors. For example, if a fund has an expense ratio of 1%, and the fund's annual return is 10%, the net return to investors would be 9%. Expense ratios can vary widely depending on the type of fund, the size of the fund, and other factors. Generally, actively managed funds have higher expense ratios than passively managed funds, as they require more research and analysis by the fund managers. No exit load mutual funds. An exit load is a fee charged by mutual funds when investors sell or redeem their shares within a specified period of time after purchasing them. Exit loads are designed to discourage short-term trading and encourage long-term investing. Choosing the right mutual fund can be challenging, as there are many different types of funds with varying investment strategies, risk levels, and fees. Here are some key factors to consider when selecting a mutual fund is best. Investment objectives. Start by considering your investment objectives and goals. Are you looking for long-term growth, regular income, or a combination of both? Different mutual funds have different investment objectives, so it's important to choose one that aligns with your goals. Risk tolerance. Consider your risk tolerance, or your willingness to take on investment risk. Generally, mutual funds that invest in stocks have higher risk but also offer the potential for higher returns, while bond funds tend to have lower risk but also lower returns. Fund performance. Look at the historical performance of the mutual fund over a period of time. While past performance does not guarantee future returns, it can give you an idea of how the fund has performed under different market conditions. Fund fees. Mutual funds charge fees and expenses for managing the fund, such as management fees and operating expenses. Look for funds with lower fees, as high fees can eat into your returns over time. Fund manager. Consider the experience and track record of the fund manager. A skilled and experienced fund manager can make a big difference in the performance of the fund. Diversification. Look for a mutual fund that offers diversification across different sectors, industries, and regions to help reduce risk. Fund size. Larger funds can be more stable and may have lower fees due to economies of scale. Overall, it's important to do your research and consult with a financial advisor to choose the mutual fund that best meets your investment objectives and risk tolerance. SEEP or lump sum, which is better? Deciding between SEEP, systematic investment plan, or lump sum investments in mutual funds depends on several factors, such as your financial goals, investment horizon, risk appetite, and available funds. SEEP allows you to invest a fixed amount of money at regular intervals, typically monthly. It is a disciplined approach to investing that allows you to benefit from rupee cost averaging and compounding. This means that you can buy more units when the price is low and fewer units when the price is high, leading to a lower average cost per unit over time. SIPs are ideal for those who want to invest regularly and don't have a large amount of money to invest at once. On the other hand, a lump sum investment involves investing a large sum of money in one go. It's ideal for those who have a lump sum amount of money available and want to invest it for the long term. If you invest in a lump sum, you can take advantage of any market upswing, but there is a risk of investing at the wrong time and losing money if the market falls. Ultimately, the decision between SEEP and lump sum depends on your investment goals, risk appetite, and investment horizon. It is best to consult a financial advisor who can help you choose the best option based on your personal circumstances. If you have already invested in mutual funds, let me know in the comments whether you are doing SEEP or lump sum. I am investing in SEEP every month. I am investing 10,000 in 5 different mutual funds.